Hi guys, KP this side from InvestorWise. Hope all of you are doing good and staying safe in this pandemic. We are here to do vlog number 37 in our Decoding Equity Markets series. If you remember my last vlog, guys, which I did 2 weeks back on last Sunday, in our Q&A session, I have given you a few of the stocks like Lupin. I told you Lupin I see can head towards 1200 in times to come, and that 1200 target was done within these 2 weeks time. Glenmark I told you can do 635, that was already done. Apart from that, I told you in the metal sector I still feel there is a lot of upside left in Vedanta. I gave a recommendation at around 257, and I told you 300 might be coming in very soon, and that it did touch close to 296, I think, in the last week, and the results also have turned out to be very good for Vedanta. So Vedanta is now trading at around 272, I feel, and it's still a very attractive buy at its current price. Now, today I am covering a lot of things in this video. For the first time, I will be doing analysis of two stocks, not one. So one would be CEAT Tires and the other would be Escorts. These are the two stocks which I would be doing in-depth analysis about. Plus, I will also give you a brief idea at the end of the video on how I see markets going from here. So one more thing, we have done a lot of recommendation on a particular stock called Cheviot company, and this stock, for people who have been my clients, they would be knowing this, that for last 1 year we have been giving regular buy recommendation on Cheviot, and the stock we started tracking from around 550, I guess 550 600 rupees. We have done multiple times buying on this stock at around 550 600 range with a target of 700 725 730 750. We have done all these targets. Then just yesterday I was reading it somewhere, and this time the stock has announced a dividend of rupees 175. Yes, it's just a 800 rupees stock, and a dividend of 175 is mind boggling, right? So that's what I feel. If we do our research work properly, if we are understanding the business models, if we understand how companies operate, their fundamentals, if we do in-depth analysis, it's not really difficult to figure out which stocks can outperform the market. And I was very happy. In fact, I got a lot of messages from my clients telling me that now the stock has come into the limelight, but we have been doing trading in this stock for last 1 year, and it really makes me feel happy for all the hard work that we have been doing in figuring out stocks which can give good returns. So it's not important that you have to invest in penny stocks, or you only have to do buying in stocks which whose prices are still in single digits. That's a wrong notion. I feel even in stocks with high price, you might see a lot of value still left, and that is how you got to find out quality stocks. It has nothing to do with the price. So if I talk about MRF, which is the most expensive stock today in India, even at this price, maybe MRF is a very good buy. All you need to see is, does the fundamentals of the stock support more upside in the stock? That is what has to be seen, and how those fundamentals are analyzed will depend on large number of parameters. And doing these videos week after week, keeping them lengthy videos with a time span of 30 to 35 minutes being spent on single stock, the whole idea is to teach you how the fundamental analysis is done. Would it impact my business of advisory services? Probably not. I don't think so. But yes, learning is important, guys, and that is the most important motive for me to be in the equity markets. That I should not just help you earn money, but I have to make you matured in the process. Be it my clients, be it my followers of InvestorWise, be it any random guy who looks into my videos. A lot of learning has to be done. So I'll be starting with CEAT Limited. A small introduction about the company. It's owned by the RPG Group, leading tire manufacturing company in India. Most of us are aware about the brands, right? CEAT and Escorts, nothing new. But I feel at a given price, I personally feel these two stocks look very attractive to me. And since markets have been experiencing a lot of volatility, so I don't want to experiment. If I can find blue chips which are still trading at good prices, I would stick to those stocks, because I have to be a little defensive. I don't want to go very aggressive experimenting with new stocks. So this company was established in 1924, which means it's almost 100 years old company. They started their operations in Italy, and they have been now doing business of close to 165 million tires a year, which is a huge business. And they are doing it for passenger cars, two wheelers, trucks, buses, tractors, auto rickshaws. So almost like all the segments of auto vehicles, they have been manufacturing the tires. Harsh Goenka is the chairman of the company, and the company is headquartered in Worli, Mumbai. So Harsh Goenka was in news in last couple of weeks, but for not so good reasons. And I posted it on InvestorWise page that there was a tweet trending on Twitter saying boycott CEAT. So I'll tell you the reason for that is that Mr. Harsh Goenka has posted certain jokes. He cracked certain jokes which didn't go well with the bigots in the Hindu religion. So a lot of people started posting the tweets saying boycott CEAT. That time I think the stock was trading around 1450. From there we saw a correction. So that was, yeah, one time momentary correction came in. Maybe that was a result of this particular tweet spreading like wildfire on Twitter. But after that, the company declared its results. After results, I have waited patiently for stock to consolidate in a given range, and only then I decided, okay, now it's good time to enter the stock. A clear-cut disclaimer here: I have Escorts and CEAT both in my own portfolio, plus in most of my clients' portfolio, be it APM clients or S2T2 clients. We have it. We have given a strong recommendation on these two stocks to almost all our clients. So that's a disclaimer, guys. As far as the price range is concerned, current market price for CEAT is 1287. If I look at its 52-week high, it did 1763 on 4th of February. And if you see from its 52 weeks high, from Feb to May month, the stock has corrected almost 27%. So stock is trading at a discount of 27%. Its 52-week low is 711. I personally feel the stock is still highly underpriced with a face value of rupees 10 and trading at 1287. It is indeed an inexpensive stock. When you compare it with companies like Balkrishna Industry, or you compare it with MRF, or for that matter you compare it with TVS, Shri Chakra, CEAT, these are the other stocks which I mentioned are also my favorites in the tire manufacturing industry. But for me, CEAT at its current price looks very, very undervalued. If I talk about its fundamentals with a staggering EPS of 105, for me any stock with a EPS greater than 50, it attracts me. But for this stock, having its EPS of rupees 105 makes it very, very good deal. Its P ratio is just 12 times, whereas the industry average P ratio is 24.5 times. So you understand, if the fundamentals of the stock are good and still we find the stock to have a low PE ratio compared to the industry average, that really makes it look attractive. And so sometimes P ratio might be down for a given stock compared to the industry average, but then it may be down because the stock is not performing well, or they have some management issues, or their operations are not going in a smooth manner, or their products are being beaten down by the competition. If those are not the reasons, then yes, stocks with good fundamentals, if their P ratio is still less than the industry average, it makes it a good buy. And that is what we are trying to understand. Are the other fundamentals good for CEAT? If yes, then with this pricing, CEAT looks a good buy for us. Book value is massive, 826 rupees. So you understand, I've always told you, if you find any stocks with price to book value of less than 2 or around 2 times, it's a very good deal for us, right? So its price to book value is just 1.56 times. That makes you clearly understand CEAT is very, very cheap at its current value. There is a delivery of close to 42% in the stock. It's not in the FNO segment, guys, so obviously the volatility is not much. Most people don't enter into the stock for speculation. There is a delivery of 42%. It's considered healthy delivery. Okay, its beta is 0.74 times. A beta value less than 1 is always making a stock stable, less volatile, and defensive. CEAT is a defensive stock. So when you buy a CEAT, you can't expect a lot of volatility in this stock. But for those of you who have the patience, they know buy right, sit tight policy, then I think CEAT is a great investment. Making it very clear, I'm not expecting some wild movements in the stock, but I feel if you invest your money in it, it will definitely give you good returns. Okay, if I look at its profit figures, guys, and I do the quarterly analysis, as I told you, the results for March period have been declared recently by the company. Its sales figures have gone up from 1573 crores, 1573 crores to 2289 crores. During this quarter to quarter analysis, if we do that, is we compare March 20 with March 21, their sales have gone up decently by around 50%, and their net profits have grown from 49 crores to 145 crores. This is where I found the stock very, very attractive. Their profits have been good, although the street estimations were even a little higher. But I feel it's okay. They have done a jump of 196% in their profits, with no extraordinary profits or no non-recurring profits coming in. So a jump of 196% in the profits speaks a volume for the script. If I do the analysis on annual basis, the net profits have grown from 212 to 395 crores, which means it even on annual basis, if we look at the results, that is year on year comparison, if we do, the stock has almost done, 100% jump in profits, close to 100% jump. And that is, to be precise, it's 86% growth, which it has registered on annual basis. And EPS also has doubled from March 20 to March 21. Like I told you, the current EPS is close to 105. Last year, its EPS was 57, which makes it very, very attractive at its current price. Its share capital is just 40 crores, but it has a reserves of 3275 crores. So you can understand, if you compare the reserves with respect to share capital, they are sitting on 3200 crores of reserves, which makes it a cash rich company. Their return on equity is 13%, return on capital employed is also close to 13%, because the company has a very limited debt. Debt to equity is 0.41, and interest coverage ratio is 3.74 times. Higher the interest coverage ratio, more safe the company is as far as its interest burden is concerned. So this company has less burden of interest, because they have less liability, they have less outside debt. If we talk about its shareholding pattern, the promoters are holding 46.82%. The promoters in recent times have reduced their stake in the company. Earlier it was 51%, but now it's down to 46.82%. But good news is everything is unpledged. FII recently have increased their stake from 25% to 27%. Yes, FII is holding for 27% stake in this company, and DII also has increased its stake from 12.66% to 16%. Now this is something unusual. Normally you will see that when FII will increase its stake in the companies, DII will reduce it, and vice versa, because when suddenly more buying comes in by the FII, DII will slowly reduce their stake. But there are very few companies where you will find both of them increasing their stake. Not just that, listen carefully, from June 19 to March 21, if I look at the data, June 19 to March 21, which is like almost 1.5 years, mutual funds have increased their stake from 3.1% to 9.1%. Now that is very, very important for you to analyze. If mutual funds are slowly adding up on a particular script, it means they see a great potential for upside in a stock. Okay, so mutual funds have increased their stake from 3.1% to 9.1%. Now from 9th of April, the 9th of April, which means just 1 month back, I'm talking about 9th of April, the stock was trading at 1589, and from there the stock has come down to 1287. Recently the stock has corrected by almost 300 rupees, which it puts you in a decent place that, yeah, now I can enter the stock. During all this time I was just waiting and watching this stock and waiting for the results to come out. Although in the in the news channels and all, they will say the results have not been as per expectations, but it has still done significantly well, whether we do the analysis on QOQ basis or YOY basis. Apart from that, one thing which really impacts the tire manufacturing companies is the price of crude oil, because crude oil is one of the indirect raw materials for the tires manufacturing. So the rubber which is used in tires manufacturing, that if crude oil prices will go up, then the cost of developing that will go up. So this carbon black, synthetic rubber, and nylon tires, cord and all this fabric, they make up for 50% of the production cost for the tire manufacturing companies. So when the crude oil prices will go up, then yes, the tire manufacturing companies will see some fall in their profitability. We don't anticipate an aggressive increase in the crude prices as of now, so that should not be a risk. Yes, the other thing which has a lot of impact on tire manufacturing companies is the demand for auto sector. If the demand for overall vehicles is going down, then obviously it will hurt the tire manufacturing companies as well. But since now we are standing at a point of time where probably we can say that maybe COVID has peaked out for its second wave, because for the last 1 week or so, if you see the trend, the numbers have not been surpassing 4 lakhs. In fact, it has started coming down, and the numbers which have been reported today was 3.11 lakhs. So by God's grace, probably we feel the things are coming under control. And going by that, once revival will start, I feel, since we have seen a lot of upside in IT, pharma, metal, so now we are anticipating that from here on, once things get back to normal, probably auto sector still has a lot of action left. So if there is surge in demand for auto stocks or auto products, then automatically it will have a good impact on tire manufacturing companies as well. Now, currently trading at 1287, people with a very short term vision can wait for a target of 1365, 1370. That is my first target, and then from there on, I feel the stock may also go up to 1425. That is my second target. But if you have a short term vision, guys, my suggestion would be to exit this stock at around 1365. Repeating myself, 1287 the current market price. Look for an immediate target of 1365, which is my short term target, and once it is able to sustain above 1365, we might end up seeing something between 1425 to 1450. That is my target for a little longer period. Do we need a stop loss? Probably not required, because of the fact that I have given you all the fundamentals of the stock, and we see a lot of accumulation being done by the institutional investors, so you don't have any reasons for exiting the stock. But if overall markets will show correction, which I don't anticipate from here, if overall markets will show correction, then yes, if the stock goes down to 1185, you might start averaging the stock. Don't do aggressive averaging. Maybe of your total exposure, you can add up 25% over there. If the stock goes down to 1185, 1190, I personally feel that shouldn't happen. We have to be prepared for everything, because nobody knows which way the market is going, and people who claim they know where market is heading, don't listen to them. Okay, keep that as a golden mantra in your mind. Coming to the second stock is Escorts. So this is a one offer going on right now. So I'm covering two stocks in this video. The second stock is Escorts, one of my favorites at this point of time. I feel there's no reason for Escorts to go down any further. Plus, the results they declared on Friday have been stupendous, is the word for that. Stupendous. The mind-blowing results they have come up with. And with monsoons coming in, this is only going to get better. 1944 is the year in which the company was established, which means the company is close to 80 years old now, and its operations are widely spread across 40 different countries. They are involved in tractors, manufacturing, railway equipments, automotive components, cranes. These are the products the company is making. So today both my stocks are interlinked in a way that both have an impact on them of the auto industry. So this company is mainly known for its tractors manufacturing, and this year, with the fact that company has published very good numbers for March quarter, it almost has beaten the estimates, market estimates. Plus the fact that this year we are anticipating early monsoons. Plus we are anticipating a couple of weeks back, a news has come that this year monsoons are expected to be good. So we anticipate good demand for tractors, and Escorts is a one company which is a leader in it. So current market price is 1163, 52-week high is 1468, and low is 798, which means the stock is available at a discount of 21% from its 52-week high. It has a face value of 10. So again, if you see, for a face value of rupees 10, a stock having a value of 1163 rupees, I feel there is a lot of upside left in Escorts. Book value is 372, price to book value is close to 3 times, which is okay. It's not, you can't call it an expensive stock. Its EPS is 54.4 rupees. The P ratio is 21 times, whereas the industry average P ratio is 27.64 times, which means the stock is fairly priced at its current market price. If I do the analysis of the quarterly results, guys, from March 20 to March 21, if I compare the numbers which I told you were published on Friday, sales have grown up from 1385 to 2228 crores. From 1385 crores, the numbers have gone up to 2228 crores, and net profit has grown from 129 to 270 crores. That's humongous, right? From 129 crores, the numbers have grown up to 270 crores. That is a huge jump in the profit numbers. If I look at the annual data, the sales have grown from 5,810 crores to 7,000 crores, and net profit on year basis has grown from 472 crores to 872 crores. Nothing better can be expected from a company, isn't it? From 472 crores, it's almost a 100% jump in the numbers, and the numbers are right now, net profit numbers are 872 crores. Even their reserves have grown from 3,000 crores, approximately 3,000 crores in March 20. Now it has come close to 4,900 crores. 4,900 crores is the reserve of the company, which makes it very, very cash rich, having very little external debt, and they have the interest coverage ratio of 87 times, which means they are sitting in a very, very favorable position. If tomorrow company plans for to go for launching new products or expansion of its operations, they probably don't even need debt. They have a lot of reserves with them, and they don't have much debt outstanding in their books. They have literally no financial risk, no interest burden at all. Their return on equity is 17%. Return on capital employed is close to 22.5%. Now, if I look at their data of investments by FII from March 20 to March 21, last 1 year, if we compare, guys, FII have significantly raised its stake from 19% to 26%. And at the same time, DII has increased its stake from 15% to 18%. If you see, DII and FII together are holding close to 44% in the company, and promoters are holding around 37% in the company, which has been stable for last 1 year, and it's absolutely unpledged. Has to be unpledged because of the fact that company does not have a lot of debt in its book, so they don't need to pledge their holding. Now, coming back to my conclusion on Escorts, since I told you that the stock has given very good numbers, plus we are anticipating early monsoons this year. Because of that, I feel the demand for tractors is going to go up. Plus, since the auto sector has been beaten down, and now I feel that once we are out of this fiasco of the second wave of COVID, once we see revival in the share market, probably auto sector is going to outperform. And keeping all these things in mind, I feel it's a very, very good bet at its current price of 1163. My first immediate target would be 1225. 1163. First immediate target is 1225, and my next target for the stock is 1300 rupees. If it goes past 1300, even 1400 is possible. Yes, you heard me right. If you can buy and sit on the stock, 1400 is coming, guys. It is going to come. Then I will post on Facebook also about it. So CEAT and Escorts are the two stocks which I feel are really good buys at the current price. You can definitely consider buying both of them. You might expect more volatility in Escorts as compared to CEAT. If you have to choose one between the two, I would personally recommend going for Escorts, not CEAT. If you have the funds and you think you can manage buying both of them, then yes, you can buy CEAT with a little longer term perspective, whereas Escorts might give you returns quickly. So if a lot of people keep asking me, how do you see markets from here? First of all, I've told you this particular thing many a times, that I don't have a short-term vision in the market. We are here to stay in the market, and we are extremely bullish on the market. Yes, last 1 week has been a little difficult, especially for the fact that nothing specific has gone wrong with India. Is at least statistics are showing that things are now under control, with lot of supplies coming in for oxygen concentrators, oxygen cylinders. Things compared to where we were standing 1 month back, things are looking a little more controlled now, and with new oxygen plants being set up, a lot of help coming in from the neighboring countries who have shown their friendly gestures, plus Sputnik now being made available in India. Suddenly there is a surge in the production for Covishield and Covaxin. So keeping all these things in mind, the positivity rate of COVID going down in Delhi, last reported yesterday, I think it was just 12% positivity rate. Overall, if you see numbers not going past 4 lakhs, whereas we were anticipating it might go to 5 lakhs, 6 lakhs, 7 lakhs also, but numbers being reported are pretty low now. So we did not have anything specific in last week for Indian markets to go down. But overall, if you see the US markets, because of the adverse inflation data, the lot of corrections came in on Tuesday and Wednesday in the US markets, followed by a very strong comeback on Thursday and Friday. So Friday also I was anticipating that markets might show some upside, but it didn't happen. We were struggling and the markets were very choppy on Friday. So I'm expecting a great comeback tomorrow, that is on Monday. Given all these conditions, I won't be surprised if we see Nifty comfortably going past 15,200 mark. Uh, uh, Overall, if you see, I have always been a firm believer, be it Nifty at 10,000 points or 15,000 points, does not matter. I have been somebody who has always been a firm believer that it has to be a stock specific bet. Yeah, we can do top down analysis and bottoms up analysis for sure, but at the end of the day, I would love to bet my money on stocks rather than going for the overall market scenario. it, Last week we have done a lot of profit booking in multiple stocks even when markets were not doing good. We have done profit booking in Tata Motors. We entered at 295 or so. We have done exits at around 325, 330. We entered Dixon. We entered at 3800, 3825. We exited at 3999. There's so many stocks we bought Sun Pharma at around 490. We exited at around 512 or so. So there is no, the list goes on, guys. I told we are working day in day out, tracking more than 500 stocks, looking for opportunities wherever we can create one. We just go for concentrated portfolios, buying in hefty numbers. Small movements will also give us good profits. So that is our strategy of doing trades. So it's not like overall market ka kya scene lag raha hai. Doesn't matter. If as I told you, last week was terribly bad for the markets overall. If you see, going by the Sensex and Nifty numbers, we had a very hectic time. We have booked a lot of profits. So it has to be stock specific, guys. And as long as you don't understand that, you don't understand this thing, you will always be derived more by overall market scenario kaisa hai, overall market scenario kaisa hai. Markets, it might even happen that when markets are going up, okay, what do you say? If Sensex goes up by 500 points, does that mean every stock is performing? No, it's not like that. If you pick up shit, it has to perform like shit, right? And if you know how to pick up gem stocks in the market, then it doesn't even really matter. Yeah, some corrections might happen when the overall market is falling. Sabko chot lagega. Every stock will get impacted. But then if you know how to handpick good stocks, then the revival is going to happen pretty fast. Okay, and you will always feel safe and secure. Even for my FST clients, I've always made them buy. We are doing futures, but we're not doing on speculative counters. We're doing it in blue chips, fundamentally good stocks. So even if stock corrects a lot, my clients have been taught this. They have become so mature. They will never worry about it because they know what they have purchased is a gem of a stock, and they can continue holding it for maybe 1 month, 2 months, 3 months. We don't really bother about it. And at the end of the year, if I'm still able to give them 50, 60, 70% return on their capital, what else do you want? No other asset class can even give 1/5 of the return of what we are generating in FST. So has to be, it's more like equity markets are more like science. If you understand, you understand. If you don't understand, don't apply brains. Go to some expert for taking services. If you don't have the patience, don't be in equity markets, because anyways you won't be able to survive for long. So I keep giving suggestions as and when possible. Everybody have their own way of doing trades. It's a subjective thing. Whenever you come up with something which is contradicting my principles, I always say thumbs up, because I don't want to challenge anybody on it. Everybody are doing it in their own manner. I am here to share my personal way of doing it. And in these 11 years of my dealing in equity market, I have felt that this approach of buying right, holding on to it, having patience, having the maturity to understand the fundamentals of the scripts, these things will take you long way in equity markets. Okay, so I hope you enjoyed the video, guys. Probably next week I would plan a Q&A session depending on my schedules. Till we meet again, God bless all of you. Thank you.